We're very excited to have everyone here for our discussion today on scaling impact using through private capital. We have a panel of seasoned practitioners, I would say, and I'll just introduce them very quickly. We have Ivan Kwong, principal at KKR's Global Impact team. Now, KKR has a $1.3 billion global impact fund that closed in 2020, which targets middle market private equity opportunities. Its portfolio includes education services provider Equest in Vietnam, waste management services provider Resustainability in India, and Australian carbon capture company Green Collar. And then next to him we have from BlueOrchard Finance, Mahesh Joshi, Head of Private Equity Investment Asia. BlueOrchard is a Swiss impact investment manager founded in 2001. It offers impact investments across asset classes, including credit and private equity, and has over $3.5 billion in assets under management. And the firm was acquired by Schroders in 2019. And next to me is Chik Chiew, CEO and Executive Director of Heritas Capital, which started out in 1997 as an investment arm of IMC Group. Now, the firm has both PE and VC funds, as well as a fund of funds, and a portfolio of biotech, healthcare, and edtech companies. So today's discussion, we're centering it on impact investing, which is a global market, as I'm sure you've heard, estimated at over $700 billion, and how private capital in this space has ramped up quite significantly. Now, the term impact investing, as you might have heard, is often attributed to the Rockefeller Foundation's efforts from 2007. And ESG, on the other hand, depending on who you ask, has its roots in the 1960s, or ESG issues that were first mooted in the 2006 UN Principles for Responsible Investment report. Now, I suppose to be clear, really, about what we're talking about today, I think we should start with what's the key distinction. When we talk about impact investments, maybe Ivan, if you'd like to take that question first, understand that KKR has been integrating ESG into its investments in the last decade, for example, and in 2019 set up a dedicated global impact strategy.
Yeah, thanks, Michelle, and good afternoon, everyone. Thanks for having us. So I think maybe it's just worthwhile starting with a bit of definition, because one of the things that is often confusing about this field is, what's ESG, what's impact, and then you've got an alphabet soup of acronyms. And so the way we kind of think about it at KKR is that ESG is really how you operate versus impact is what you're selling, right? So how you operate, you could be a garment manufacturer, and you have very good labor policies, very good environmental policies. That's how you operate. That's ESG. Impact is a little bit more than that. It's what you sell. So you could be, some of the examples you mentioned before, Michelle, you could be talking about an education provider targeting, the middle class emerging Vietnamese society, right? That's what you're selling. Or it could be Green Collar, which is in the carbon credits development space. So I think those two are kind of the way we think about it. So when we talk about impact investing at KKR, it's really the latter group, of companies that are kind of doing something proactively positive either to the society or to the environment.
Right. Mahesh, how about over to you? I mean, BlueOrchard has been in the business, so to speak, for about 20 years, starting off with private debt. So how has the thinking in the space evolved, particularly in today's environment?
Yeah, so BlueOrchard has been was set up in early 2000s with the objective of driving financial inclusion globally. So in that sense, the work that BlueOrchard has been doing precedes the term impact investing, because it was coined towards late 2000s. Now, obviously that definition has evolved over time, and for a large part of this 15 or so years that people have been talking about impact investing, the term has been very loosely defined. And there has been significant room for interpretation as well. But over the recent time, I think around 2019 or so, IFC has come out with some structure or structural definition for impact investing. And the way the impact investing is defined today, for an investment to qualify as an impact investment, you need essentially three things. You need to start with intent. And intent in today's world is communicated as alignment with the SDGs, but you don't necessarily have to be. It doesn't necessarily have to be that. You can figure out what is that you want to make a change towards, as Ivan was referring to. Then you need to have a way of contributing towards that intent, and preferably in forms outside of the capital that you're providing. And finally, you need to be able to measure the impact that you're able to create. So if you combine these three, then you can call yourself an impact investor. And as Ivan was referring, there's always confusion between ESG and impact investing, and he summarized it very nicely. Essentially, ESG is not doing anything bad. So you should not be either hurting the environment and doing right on the social norms and the governance norms. But when you look at impact investing, it goes a little further than that. And essentially what you're trying to do is, you're trying to do something good. You're trying to make a difference. And that is where, in a way, ESG is kind of the first step, or for most impact investors, ESG is the basic minimum that they would require for an investment to happen. So that's the, I would say, the key difference between ESG and impact.
Why Chiew? So Heritas just last month launched an impact fund specifically. I mean, could you take us through briefly the backstory to that?
Yeah, maybe I just give you a bit of a backdrop to this. So Heritas have begun the ESG kind of story from 2013 when we got a CMS license. And it was through initially a mindful selection of industries that we choose to focus on, the so-called do well, do good industries like healthcare. And over time, we expanded to education, food, and now sustainability. Right? So these are all very deliberate choices that we have made because these industries represent a very good opportunity to benefit someone from the way we invest, so with purpose and really trying to impact generations. So that's the overarching kind of philosophy. So as Michelle mentioned, last month we announced launching an Impact First Fund. So this is really moving it to another category in our impact investment landscape, right? Because there are the impact funds that we see out in the market more and more, which we like. We really enjoy seeing that. But we also met a lot of social enterprises that came to Heritas and say, could you fund us? Right? And some of the social enterprises, if you are familiar with them, they do have a mission to contribute to environment or social objectives. Right? That's their reason for existence. So from every standpoint, we consider them like impact first. However, for the impact funds that we have launched before, we find that it's very hard to justify investing in them with the kind of invest with impact kind of mandate. Right, looking at say 15-20% double-digit type of IRR. So when I go around in last year, right, talking to various social enterprise stakeholders like RAISE and DBS Foundation, many philanthropic families, and so on and so forth, I learned a lot. And we realized that perhaps what we need to do to really catalyze this whole ecosystem of impact investing is really to create an impact first fund. This is probably one of the first of its kind, if not the first, in Asia, where we are targeted at supporting social enterprises. And we tell our investors very plainly that we are looking at concessionary return of 5 to 10%. So it is what it is, right? There is the debate on whether impact investing got to come with reduced returns or not, right? And here we are talking about a category of impact investment called Impact First, where we say, yes, it will be reduced returns, but we also want to make sure that we are supporting the companies whose DNA is really to do good, right? So that's why we created that Impact First Fund.
Well, we'll come back to that point specifically later, but maybe Ivan, given KKR's history as a traditional buyout fund, I just wanted to understand why it was important for the firm to commit to an impact strategy.
Yeah, thanks, Michelle. I think it really comes down to kind of two things, both of which are equally important. So on the one hand, we feel like it's our social responsibility to scale up commercial solutions that are advancing at least one of the UN SDGs. And it kind of goes to the DNA of who we are as a responsible investor, and it really goes to kind of, the power that we feel like we have with private capital to really scale up impact. So if you haven't already, our most recent impact report, which you can download from our website, the title of that is literally called Scaling Up. So I think there's that one part, which is just this opportunity to do something really, really amazing. On the other hand, we also think that by investing in commercialized mid-market companies using a private equity kind of approach, we actually think we can generate very attractive private equity returns. And so we can have this debate about, what is the right level of cost of capital for this category. But the way we think about this is, we've got 4 key themes that we're investing behind. And these are kind of really long-term secular themes around climate, around education, around financial inclusion, around sustainability. And so we actually think these themes will kind of power us through and actually give us, resiliency through COVID, resiliency through inflation periods, and then resilience through kind of economic downturns as well, because we are solving solutions that customers are willing to pay for.
Right. And speaking of scaling up, we'll come to you, Uttari. Yes. And no pun intended. I mean, as an entrepreneur with a very particular mission of creating sort of this ecosystem so that's sustainable and fair for small-scale fishermen, what does impact mean for Aruna?
Thank you so much for having us. So Aruna is one of the largest integrated fisheries commerce from Indonesia. Nowadays, we have 36,000 fishermen. Most of them is small scale, living in the coastal village, and we help them to connect with the global B2B markets such as US and China. Most of the time, the challenge for us to create the impact is actually about how we can measure the impact, like we already discussed before. So we tend to help the fishermen to connect with the market, but it's how about after we get them like the better income, then what is the impact for themselves? What is the things that very important for them? For example, the school of their children, or the more income, or maybe the insurance for their family. So I think that's about how we leveraging the impact to our fishermen.
Right. But from the perspective of a business owner, how has the company's sort of operations evolved as it grew with the backing of private capital? And as an entrepreneur, what do you look for from the investors?
Yeah, I think the good things is there is many impact fund nowadays compared like before when we start Aruna. So what we're looking for is actually the investors that can be like the partners that can help us like develop our maybe ESG metrics or sustainable goals, because it's important to have the investor and partner that have the same perspective with us. It's true we need to create the profit first, because if not, then how we can help the others. But then, how if we can have the profit, then we can create that as also an impact, so then our company will be more sustained in the future. So I think that's about having the same mindset with the investor for that.
Right. So with that, I wanted to turn to look again at the opportunity set in Asia, staying with you, Uttari. So when you founded Aruna, I mean, what were the gaps in the industry that you saw that, made you decide that, that resulted in Aruna being set up? And following on from that, what difference to the industry has it made?
Yeah, as the children that grow up in the fishing industry, so my family actually from the fisherman background, so I very understand that how we have like this impact compared to other industry, for example mining, or for example like the banking. It's different. Fishery is one of the latest industry and it's very left behind. The gap is most likely because we don't have understanding about how to maintain the quality of the products and how we can have the real data about the production, so then we can export, for example, the product itself. And the last is about the connectivity, because we live, especially in Indonesia, there's so many islands, so it's so hard to have like a good connectivity. And I think the difference after Aruna is because we create like this community, but we also creating the local heroes. So it's like the one that help us operating our technology and help the fishermen so they can use our technology and also improve their quality and provide it to the customers. So by having that, then in the future we can like develop the margin not just for the fishermen but also for the Aruna as a company. And we already done the research. So after join Aruna, most of the time fishermen have a better income, 2 until 3 times higher. One fishing village can contribute it like 100 million rupiah per month, because it gives contribution to their fishermen, but also the family, because we also give training to the woman workers. Most likely is a fisherman wife, so we give them training to do quality control to maintain the quality of the seafood. So it's about creating the social, but also implementing the technology for the impact.
Right, that's great. Chiew, if I could come back to you, you mentioned earlier the types of companies that come to you. Just wanted to understand, so you had a growth fund before and VC fund, and now you're targeting like early stage companies. Just wanted to understand the thinking behind that, selecting early stage companies.
Right. So we do run a few kinds of impact funds. We do venture funds where we look at companies at seed stage and Series A. We do a growth fund where it might be from Series B onwards type of fundraising. Those funds are focused on looking at emerging industry champions. So the lenses that we apply is really leveraging our domain expertise on healthcare, on education, on food areas in order to assess whether these companies have the potential, right? So we are funding for potential disruption or very long runway of growth in a way that they will also create impact, right? So this is really investing with impact. And that contrasts with our most recent fund launch, which is Impact First, where we are looking at a category of businesses called social enterprises. And they could still be in education, still in healthcare, still in training and others, but their kind of origins and their purpose of existence was slightly different. So we segment accordingly, and the returns that we target also reflect the differences.
Yeah, but what about the investable set? Do you see it as a smaller set compared to your previous funds? Yeah.
Oh, no. Actually, we do landscape studies. There are a lot of reports out there on social enterprises. I didn't know there were so many until we did the research. Just in Southeast Asia and India, we are talking about 3 million social enterprises. And actually 40% of them are actually profitable. So it's unlike what most people think, that social enterprises are generally not making money. But yes, many of them are actually very subscale. In Singapore alone, we saw the data, 90% of social enterprises have revenue less than 1 million, right? So you can see, that is the state of such business. But in terms of the number of such companies, there are a lot. And since there aren't that many impact first funds around, I think we do have a sufficiently large investable set. And we are actually targeting really a select group of social enterprises who are the emerging champions of social enterprises. And our thesis is that if we can bring these guys to the next level, I think it's also within their DNA to turn around and help those behind them. And that is really very much the essence of social enterprises. And through this effort, we want to catalyze and really uplift the whole ecosystem for social enterprises, just as we have done for other startup ecosystems here in this region.
Right, interesting. I've been coming back to you. KKR looks at a completely different market segment, the PE middle market, as it were. And would you say that the Impact Fund has a smaller investable opportunity compared to, say, the traditional funds? Or has that changed, actually?
Yeah, look, I think, Michelle, if you start from the premise that the private sector, for a long period of time, has had a very important role in solving a lot of society's biggest challenges, whether it's climate, whether it's portions of kind of education access, whether it's portions of financial credit access, whether it's things like agriculture. If you start with that premise, there's actually an enormous opportunity set, because there are so many companies out there that are doing really exciting things. And then from a culture perspective, you also have this next wave of employees, of workers, who actually want to work for companies like yours that actually have kind of that profit plus purpose aspect. So when we actually talk to a lot of our companies, including the ones we eventually invest in, the fact that we come in with both the global resources of KKR, but also that values and that culture alignment of an impact fund and what we can do, that's actually quite powerful. So the short answer is no, not really. It hasn't really stopped us from being very busy.
Yeah. Mahesh, to you though, BlueOrchard focuses on sort of climate resilience through insurance, as insurtech, and financial inclusion. How much more proactive do you think sort of you have had to be, or in general, I suppose, impact investors have had to be when looking for targets?
Right. In our case, at least, it's slightly different from KKR in the sense that the fund that we're investing out of, it's called Insure Resilience Investment Fund. At this point of time, will gradually expand into financial inclusion as well, as Michelle mentioned. But at this point of time, we are trying to build climate resilience through that fund, and the objective is to reach out to low and middle income people in emerging markets and help them access insurance products that could come in handy when there is a weather event. So in that sense, the focus is very, very niche and narrow. Obviously, it's challenging to find those opportunities. See, on the positive side, obviously, Southeast Asia is one of the best markets to do that work in. We all know Southeast Asia as a region is very vulnerable to climate change. So this is the area that we need to find opportunities in. And though the work is hard in terms of finding those opportunities, working with these people, there's a lot of value in doing that, largely because if you focus on a niche segment, it helps you through the entire investment life cycle, right from your sourcing to then finding the right opportunities or selecting the right opportunities, then to portfolio management and exit. On sourcing, you're probably not following what are the latest trends in the market. You're trying to focus on what is it that you can do and the problem that you can solve. Then from a deal selection perspective, because you're focused on a very niche segment, you have that much more knowledge to make the right choices. And obviously in the portfolio management, your portfolio itself over time adds value to each other, but you can bring in a lot more expertise in terms of network, in terms of the right strategy to grow these companies. So while it is difficult to find those opportunities, there is a lot more value to be created through that.
I mean, given all that we've said, I mean, would you say that much of the investment we're looking at takes place in the emerging markets, as it were, or in sort of newer, non-traditional business models? So, I mean, now we can talk about a little bit of the risks involved, or how do you mitigate the risks involved? What does it mean when it comes to doing due diligence, for example? I don't know, Ivan, if you want to take that question first.
Yeah, so for us, it's not that different from our, just overall private equity process. When you're investing in emerging markets and talking about risks, it's all the same. I think on the prior panel they talk about the importance of the promoter, so that's the same. I think one thing we don't do, obviously, as a later stage investor is take technology risk or product risk. So our job really is to kind of scale up products or services that have been proven, and sometimes that means taking things, kind of beyond the borders of the company, of the country where the company is based. And so I think, if you think about how we assess risks in the impact fund, it's really the same playbook that we have deployed in our private equity. I think the one thing that we're always mindful of as an impact investor is, of course, just that authenticity of the impact. I think Mahesh talked earlier about the measurement, and sometimes people say, is that like a bit of a pain? There's just extra measurements, extra reporting. I actually think it's the opposite. So without kind of being too specific, amongst our education portfolio, for example, one of the things about education is you really need to prove the efficacy, right? Because you can always count the number of students and so on, but how do you know that the product actually works? So we spend a lot of time working with the management teams, sometimes working with kind of third-party experts in the field to really kind of prove out that efficacy, to run studies, to run surveys, to run data analysis. And the first people that the company takes that data to is not actually us, it's the salespeople. Because then they go to the students or the teachers or the schools and say, hey, or the government and say, hey, our product really works. Please, buy a product. So, from that perspective, there's kind of very strong alignment between, us wanting to kind of not just mitigate the impact risks, but actually turn it into an opportunity, that enhances the business value.
Right. Why Chiew coming to you, as you said, social enterprises, I mean, if they function on a different plane, for example, where are we at when we look at the risks or when you do due diligence, for example?
Yeah, so I like what Ivan say. I mean, I think he's looking at the mid-cap. And I mentioned earlier, some of the social enterprises that we have come across are still at the pretty early and, small scale for now, right? So I think we have to study in terms of the business risk. Some of them may be implementing some new technology or new business models. So there are some added risks there. But at the same time, I think what many of these social enterprises are hoping to achieve, right, is really new ways of doing things. Sometimes I look at impact investing. There is a bit of a barter trade going on, where you provide this to someone who can provide you something else for free sometimes, right? And then you create a circular system where you trade a lot of your resources in order to make it work, and overall value is created. So we do have to think out of the box on some of these new business models, and it does carry some interesting risks that we do have. I mean, so it's related to its small size or the stage of maturity of the business model, but it does make life a lot more interesting.
Yeah. Okay. At this point, I'd like to invite the audience to submit your questions if you have any on the Slido platform. And we do have one question here, which I think perhaps is a good time to ask, is who are the typical LPs in impact funds? I mean, how would you raise impact funds for poorer countries in South and Southeast Asia? Mahesh?
It's a good question, and impact investing technically is a very wide spectrum. So on one side, there are people who are able to raise concessionary capital, like Heritas. On the other end of the spectrum, there is KKR, which is purely commercial. I would say we are somewhere in between. We are able to raise some concessionary capital, some blended finance mandates, as well as purely commercial capital. So it also depends on the kind of capital that you're raising. But most of the times, if it's a first-time fund manager, very likely it is going to be the DFIs who are going to support them. But I'm guessing in case of institutions which have a very good track record, like KKR, their existing investors who have been backing them for a long period of time is a good set to kind of go towards. Even for BlueOrchard, we have been generating commercial returns for our investors for a long period of time. And they vary from large private banking houses to DFIs, to pension funds, to insurance companies. So it's a very wide set.
Ivan, would it be from existing relationships, for example, for your impact fund?
Yeah, I won't go into too much specifics, but maybe I'll just say, we kind of feel like part of our mission is really to bring impact investing into the mainstream. Because as I mentioned before, it's really about investing behind really strong secular industry tailwinds and generating attractive private equity type returns. So from that perspective, we kind of just see this as an extension of our private equity strategy.
Right.
Yeah, I would just speak from the perspective of running, investing with impact, which means we still look for commercial returns in our venture and growth funds, and then we are proposing concessionary returns in the impact first fund, right? So there's a certain segmentation, and I believe that investors self-select, right? Because there are those who believe that, investing in products and services that not only do well but do good, they will tend to select engaging us on the venture and growth funds for different stages and risk preferences. But for some of the philanthropic families, for example, right, they have a track record in philanthropy, and they also realize that you can't keep making donations sometimes or giving grants by some foundations, and they wanted to experiment, what if we do it the venture philanthropy way? Right? And for us, we bring our expertise managing ventures into venture philanthropy, and that is something that we say, hey, there's a meeting of minds, let's launch an impact first fund. So in a way, it is quite, I would say, it's quite incidental, where there's a meeting of minds between like-minded people, investors and fund managers of the right backgrounds, right, and come together and try out the new ways of doing things. And that's how we launch different funds to suit different risk, reward, and impact preferences.
Right. I think at this point I want to come back to what we sort of touched on briefly earlier about measuring impact. And I think what people want to know is, how do you quantify the impact portion of the return, particularly if there aren't yet sort of consistent metrics, such as in traditional PE investments. I mean, we've talked about how there are different definitions to begin with. But how has this been developing, given that this has been part of the conversation for a long time? Maybe, Mahesh, you can take the question first, and we go to Ivan.
So from a measurement perspective, measurement, as I talked about, is an integral part of being an impact investor. At BlueOrchard, we have like a 12 to 15 member team which is dedicated to just making sure that we are measuring the outcome properly. And when you look at how measurement is being done, obviously things have evolved over time, but even now it's very, very dispersed. But overall, I think there will be across, measurement methods could be classified as 3 types. One is you measure the target, whether you're reaching the right target audience or not, and the number of people that you're reaching out to as beneficiaries. The second way is kind of measuring it as a financial return. It's a very complicated method of doing it, but some firms do it. And the third one is a balanced scorecard, where you're measuring various outcomes, as Ivan mentioned, whether the product is effective or not. So there are various sets of outcomes that you measure. And most firms follow a mix of these and have their own framework that they develop around this one. We have our own framework that we have built incorporating ESG, SDG alignment, and impact measurement. And at this point of time, because there are various frameworks going around, GPs and LPs are also learning. And I think in future or the next few years, probably these things will converge. A lot of convergence has already happened, especially in the measurement of greenhouse emissions, for instance. I think even on the impact side, that convergence will continue and we'll have standardized process to measure impact.
Right. And I mean, just trying to understand, though, given that an investment does take a long time to produce results, and how does one actually track or prove sort of direct cause and effect between the capital injection and the outcome? Ivan?
Yeah, so one of the key concepts when we talk about impact investment is the concept of additionality. And so what it means is, when we come in as an investor, are we helping to change the trajectory of the business? And it doesn't have to be a U-turn. It better not be a U-turn. But are we helping them scale up? So some examples of how we help them is, for example, through our KKR Capstone team, which is our bench of operational executives that can do simple things like debottlenecking a factory operation so they can produce more machines, for example. It could be things like supporting them with kind of really creative and strategic M&A to expand overseas and then to roll out the core products through that channel. It could be through just connecting them with the right experts and the right advisors, or bring on board the right industry independent board members, right? So we're very privileged and fortunate to have some real heavy hitters sitting on our boards that can bring decades of industry experience that really the company would not otherwise be able to access. So we can go back to the kind of the reporting side of measurements, if you like, but I think from an additionality perspective, it's really about, can we come in with our capital, with our network, with our expertise, with our experience to really help to scale up that solution.
Right. Uttari, I wanted to come to you now. Startups are all about sort of growing as fast as possible, hustling. So how does the company continue to focus on the mission that you laid out earlier and sort of build this practice around impact, And how do you measure, like you mentioned, the children?
Yeah, actually, that's true that as a startup, that one of the very important metrics is all about the growth. So how we can grow as fast as we can, but again, how we can also manage the metrics to become more impactful also together with the growth itself. So I think the perspective is very important in here. It's all about how we as a founders can see the true metrics of that can support our growth. For example, if we see ESG as the thing, as a compliance, then it can be very hurtful in the process. But if we see this ESG as one of the things that can support our process, then it can help us grow as fast as we can. Because, for example, in the ESG metrics, we have the G part. The G part is we talk about the governance, how we can help, for example, the grievance mechanism, then we can understand the problem that we have on the ground, or how we can have like the communication, openness with the team or the labor or the people that work with us, then we can help them to support their development, and by that we can help them grow. And for instance, our company also growing. And for example, the environment, because for example, in our cases, we get something from the ocean, and it means biodiversity is one of the important things. And how we can measure like the fish stock analysis, and how we can measure like the production method. And this data can be operated also to our customer, and they will be happy happy and they want to pay more because we can provide more sustainable supply for them. So I think it's very important to us as a founder to choose the metrics that can help us grow. Then we can hustle and grow more with compliance also with the ESG and impact.
Right, of course. Another question from the audience at this point. What kind of return or exits can you expect for impact funds, and what is the time horizon would you consider for such investments? Maybe Mahesh?
Again, very good question. Impact industry is very, does not have a very long history. So it's very hard to measure. But if you look at the recent report that came out on impact from Cambridge Associates, they were mentioning that the returns are very close compared to regular investments. It was about 7% versus 8% for regular investments, something like that. So there's not much divergence from the regular industry. But as I said, again, impact invests across a very wide spectrum. You have people with concessionary capital looking for not market rate returns, and you have people driving the commercial side of impact, looking for commercial business models which can make an impact in the market. So over time, my guess is if I were to answer it from the side of the investors who are addressing from a commercial perspective, they should be able to generate very similar returns to what the regular investors are able to generate. And I think probably even better because if you look at, history is not always a good benchmark for future. The times that we are living through, sustainability is becoming very, very important trend. And impact in a way rides on these trends and is probably likely to generate better returns over time.
Right. Anyone else wanted to add in? Why Chiew?
Yeah, maybe I just add a perspective. We operate like an impact investment platform where we offer different funds for different investors of different risk, reward, and impact preferences. I think there is a logic for each of these funds. And for the first time, I have got investors who come tell me that, I can put money in your impact first fund, but could you make sure that you don't return me the money, right? Yeah, but that's because the mandates of the different investors are very different. Some of them are like, we treat this as a donation, but when you have distributions, I will tell you where you should direct the capital to. Right, so this is totally not very commercial, and the aim is really truly to maximize the impact, put back every dollar, right, for philanthropic use. But we are doing it from a fund basis. I have to make sure that we do aim for and deliver the kind of target that we have indicated, right? But people are seeing it from different lenses. So I would say that's very good learning for me, right? Because it's the first time we tackle this. And of course, we can ask a lot of technical questions about how we measure and what's the risk and all those. But I simplify it for most people who are new to impact investing. Right, with a very popular saying or analogy, right? Actually, if you look at many of us from the fund management industry, a lot of things we do, whether impact or not impact, traditional, commercial, or impact first, the activities that we do looks the same. Okay, it looks the same. We still negotiate term sheets, we still negotiate valuation, we still turn up for board meetings, we still talk about business strategies. Everything looks very similar. But the saying goes that, are you laying a bricks? Or are you building a cathedral, right? Because when you see that what you are doing, right, although it looks the same, but you have a vision, an intent in mind, and that may shape the way, the commitment, and the sense of purpose that you are doing these things that you always do. But it changes everything, right? Because of that additional layer of vision and imagination of what could be so glorious and possible. So I would just hope people come back to that very central notion of what is the purpose of impact investment.
Right. On that note, last question for everybody, just have a quick round. If we were to gather again here today on this topic next year, what would be different? What do you think we'll be talking about? Uttari?
Maybe the number of the impact and how we can be more sustainable in the future.
Yes. Yeah.
I'll probably just come back to scale. So I hope that this as an asset class continues to grow. I think there's a massive opportunity set of doing what we do, and so hopefully, if we're back again next year, we'll be talking about kind of more impact, more capital, backing really awesome companies.
Mahesh?
Yeah, I think there'll be fewer questions on whether impact can generate commercial returns or not.
Yeah, no question.
Yeah, very similar. I hope that we'll be sharing very specific case studies.
Yeah. Thank you, everybody. Thank you, Uttari, Ivan, Mahesh, and Chiew for joining us this afternoon.
Thanks for having
Thank
us.
you, everyone.